from the heart of where innovation, money, and power collide. In Silicon Valley and beyond, this is Bloomberg Technology with Emily Chang.
Chang in San Francisco, and this is Bloomberg Technology. Coming up in the next hour, Netflix once again surprises a big beat in global subscribers, and it has nothing to do with Squid Game, which isn't even reflected yet in this quarter. Shares up in late trading. We'll break down the results. Plus, trading in your pandemic sweats for designer digs. Rent the Runway has revealed that subscribers are rebounding as the company looks to head to the public markets at a $1.3 billion valuation. And live from LA, we'll bring you the latest from the Milken Institute Global Conference. Bloomberg's Carol Massar will sit down with Cathie Wood of ARK Invest later this hour. We're going to get to all of that in a moment, but first let's get a look at the markets with Bloomberg's Kriti Gupta. And Kriti, a rally in stocks today. What did you see?
Absolutely, Emily. Green on the screen, and once again, tech, that really key outperformer. But it wasn't tech alone. Check out what rallied with it. Of course, those Chinese ADRs, the thing that's having so much regulatory scrutiny, really weighing on those shares. Today, they were the outperformer, up over 3% in the session. And of course, now that we have a little bit of after hours trading, you are seeing Bitcoin slipping from its highs today. But during the session, actually very strong reactions in Bitcoin, despite some of that news about Bitcoin futures. The big concern there was, would that detract from some of the populism around crypto assets in particular? But Emily, that is not the case. Looks like it's still got about a 4% bid in today's session. I wanted to bring it back to those big tech stocks, though, because they did lead the index lower over the last couple of months. But in the last 6 sessions, they've actually been leading it higher. And here I'm using Apple as kind of that proxy for those big tech names. You can really see Apple in the last 4 sessions in particular having a pretty good day. If you widen that out to Google or Alphabet or Microsoft, it becomes 5 or 6 pretty good sessions of gains. Facebook or Amazon, still a couple good sessions. So this is pretty interesting, very reflective of what you're seeing in the broader index. I want to end with the major after-hour story, and that, of course, is Netflix. Shares were up as high as 3% after hours after they beat their subscriber growth. Bloomberg was estimating 4.4 million total subscribers, Emily. They came out with 3.7, now projecting 8.5 million next quarter. So some good news out of Netflix. And on top of that, just to put that cherry on top, you did see they say that they are going to be cash flow positive, next year. That did, like I said, move shares after hours up by about 3%. But looks like pairing some of those gains, and even Disney was ticking higher. Once again, looks like pairing some of those gains, Emily.
All right, Kriti, thanks so much. I want to stick with Netflix now and bring in Andre Swanston, Senior Vice President for Entertainment and Media at TransUnion. Andre, good to have you back here on the show. So look, strongest subscriber growth of the year, even as the world continues to reopen. We're getting off our couches and going to work. Are you surprised by this?
No, I'm not at all. Actually, I think contrary to what a lot of other people think, and I really thought that the projected number was quite low and that it would be higher coming off of probably their worst quarter ever, or at least in the last 4 or 5 years. Typically, when they've had a really, really poor quarter in terms of subscriber acquisition, the increase or the following quarter is really, really substantial. And so I actually think that this was less of an increase than I would have expected to see.
So is that because Netflix is doing something wrong?
I think it's because Netflix is not really doing anything different than it has historically done. And so Netflix has been right so many times when people have doubted their strategy. I think a lot of people thought they were investing too much in international content years ago. And that's, although it wasn't reflected in these numbers, I think that holds true with the success of Lupin and Squid Games and other things. The challenge, though, is that they're still very slow to diversifying their revenue stream. And I think the concern that I would have is that when you look 3 or 4 years out, I don't think anybody doubts that a Disney Plus will probably have a larger subscriber base than Netflix. There's others that are challenging for that premium subscriber base as well, but they still don't have an ad-supported offering. The transition into gaming has been very slow. There's the diversification of revenue. There's some merchandising that they mentioned, but that doesn't compare to what a Disney or NBC Universal does. And so I think that's the biggest challenge, is that it's pretty much just more of the same.
Interesting take. Obviously, Squid Game has been the talk of the last few weeks. Netflix just announced it's been viewed in 142 million households. And, sort of the devil's advocate case here is that a company like Disney can't put Squid Game on Disney Plus. I mean, it was a risk for Netflix, and clearly it's paid off. So what makes you think they won't be able to keep on bringing hits like this and beating Disney or HBO or some of these others continually going forward?
Yeah, well, they say the past is prologue. If you look at the amount of dollars that Netflix has invested into content over the last 5 or 6 years, they've spent more money than just about anybody. And we still get riled up in terms of the media world whenever there's a huge blockbuster success with whether it's a TV show or a movie. Contrary to that, it's big news when Disney flops, because the expectation is that their content is going to be so successful and so valuable. And so when I look at Netflix, if Netflix's challenge or their battle is to just outproduce content that is better or more global or more valuable than Disney or NBC Universal or HBO, I don't think that's necessarily the game that they want to play. Because all those companies have much more ways to monetize their audience than Netflix does. And so just even to kind of stand pat over the next few years, they actually do have to have better content and bigger hits, which I think is challenging.
Interesting. Well, speaking of content, Netflix has been embroiled in a very public controversy about its Dave Chappelle special and comments that he made about trans rights. Co-CEO Ted Sarandos has defended the decision to put this on their platform. Netflix employees, some of them really not happy about this. What's your take on how much this impacts the broader Netflix story?
I haven't thought much about what the impact will be to Netflix and broader. I think there's always a challenge between when you look at freedom of speech and an artist or an actor, comedian, producer's right to be creative or to address issues. At the same time, you have to be respectful of the different constituencies that consume your content and where it's distributed. And I think that's really up for Netflix to make their own decision. I will comment on what they're deciding relative to that, but I think people need to be able to face the consequences for any decision that they make. So if they're standing behind the show or the special, I think that's their ability to do that. And whatever the repercussions of that for, if that impacts their subscriber base or other things, then I think they need to be prepared for that.
All right. Well, Andre, thanks for raising some interesting points. Andre Swanston, Senior Vice President at TransUnion. Always good to have you here on the show. Taking a look now at what else we are watching. Instacart is acquiring Caper AI, a startup that makes self-checkout shopping carts. The smart carts use image recognition cameras and weight sensors to automatically detect items placed inside. The $350 million in cash and stock deal, it's part of Instacart's effort to tap more areas of growth ahead of its anticipated public offering. And coming up, Rent the Runway announces plans to raise over $300 million in an IPO, and chipmaker Global Foundries looking for as much as $2.6 billion in its plans to go public. We'll look at a roundup of the latest offerings and what's ahead for the rest of the year. That's next. This is Bloomberg. 2021 has already been a banner year for public listings, and there are still more to come. Fashion rental company Rent the Runway is seeking to raise as much as $315 million in its upcoming IPO, which would value the company at $1.3 billion at the top of the range. For more, I'm joined by our Bloomberg Deals reporter, Crystal Z. Crystal, Rent the Runway obviously struggled in the pandemic. People weren't leaving home or getting out of pajamas, literally. So how have they recovered since the easing of lockdowns, and how is that just driving the decision to go public now?
So in looking at the S1 and the updated S1, which they launched today, it looks like financially we haven't seen as much recovery, but the number of subscribers have actually gone up. Year-on-year basis, in the first half of the year, revenue and net losses are mostly flat, but we've seen almost a double in active users this quarter compared to the beginning of their fiscal year, which was in February this year. So it seems like even though people aren't going back to the office just yet, some events are coming back, and that is prompting people to, giving them excuse to dress up again, and that could have driven their decision to go public now. But the company that warned that in their risk factor section, that how long the pandemic would go on, it's a concern, and that would severely impact their business if it could carry on for longer.
They're also cautioning in the filing they may not achieve or be able to sustain profitability. How do you expect investors to respond to a deal like this?
So it's actually pretty simple kind of language. Like most companies that haven't achieved profitability tend to put that kind of language in it. That said, it seems like people online have some, have their own thoughts on it. Some saying that the company really haven't proven that they have any ability to be profitable, and the pandemic definitely did not help. And I'm sure if they were given a chance, they would have gone public at a different time. But it seems like they have showed some recovery, even though it's not in the financial terms just yet.
Meantime, Global Foundries planning to raise $2.6 billion in their IPO. Curious if they're taking advantage of the ongoing chip crunch and how that will play into how investors look at this deal.
Yeah, I'm sure chip shortage is really playing into their favor. Them and Mubadala together are going to raise upward of $2 billion in the listing. Majority of this year, we've seen a bunch of consumer-facing technology companies. So at the tail end of this year, we're seeing Global Foundry, we're seeing Informatica. A lot of these enterprise and tech hardware companies are coming in at the back end of the year, which actually could play into the advantage because at the back end, investors tend to get a little bit more risk on. When you have a more substantial business, we have proven revenue and proven profitability, that could really do well in the end of the year. So it really is a good time for Global Foundries as well as their investors. They actually have attracted a lot of investors for Cornerstone that have indicated upward of $1 billion of interest. So the deal is $2.6 billion, but in fact, they really have to sell a lot less than that.
All right, well, we'll be looking out for the additional action coming up later this year. Crystal Z, our Bloomberg News Deals reporter, thanks so much for that update. And Thursday, catch a special edition of Bloomberg Markets, The Close, focusing on supply chain pain. Our Caroline Hyde and Romaine Bostick will be live from the second busiest container port in the United States, the port of Long Beach. As supply chain issues across the globe persist, they're going to be talking to some of the key voices impacted by the supply squeeze. Some guests, including Maria Cordero of the Port of Long Beach, Jeff Freeman, President and CEO of the Consumer Brands Association, and Jessica Caldwell, Edmunds.com Executive Director of Insights. And to another story we are watching, the first U.S. Bitcoin-linked exchange-traded fund debuts. ProShares Bitcoin Strategy ETF, Simeon Hyman, ProShares global investment strategist, shared his thoughts earlier right here on Bloomberg.
We think this is going to allow many people who've been waiting for an easy way to do this and a robust way to do this to now be involved and have it in their portfolios.
Weighing in on the new ETF, Guggenheim Global CIO Scott Minerd says it's a very exciting development and a way for investors to bypass digital wallets. Minerd spoke to Bloomberg Television at the Milken conference earlier today.
Bitcoin in and of itself is very difficult. Like for us, we've invested in Bitcoin for our clients, but you end up you have to be in something that's a tradable vehicle like an ETF. So I think the ETF is a very interesting development.
And while Minerd won't call Bitcoin a value play, he doesn't recommend shorting it. In fact, he thinks the world's most popular cryptocurrency will rise over the coming months. Take a listen.
You see Bitcoin and what it's done over the last few weeks. I can't tell you it's a value, but I won't tell you that you should short it because it's likely to be higher in the coming months.
Diplomatic there as ever. We're going to have much more from the Milken Institute Global Conference. Bloomberg's Carol Massar will be speaking with Cathie Wood of ARK Invest. We're going to bring that conversation to you live later this hour. Coming up, the American dream, or almost. We're going to talk about the challenges facing immigrants who want to start their own companies right here in the United States. After the break, we're going to speak with partners from a VC fund aimed at leveling the playing field. That is next. This is Bloomberg. The U.S. prides itself on being a nation of immigrants, and yet starting your own company as an immigrant in this country is far from easy, if not impossible, for some. My next guests are determined to change that. Manan Mehta and Maria Salamanca are with Unshackled Ventures, a fund dedicated to helping immigrant-founded companies. Manan and Maria, thank you so much for joining us. Maria, I'll start with you. What motivated you to start a fund focused on immigrant entrepreneurs?
Yeah, well, I was really lucky to be the first hire after Manan and the two co-founding partners, started the fund. But I myself am an immigrant. I'm a refugee, came to the United States when I was 7 years old from Colombia, moved to Florida with my parents, and I think ever since then have been trying to repay what this country has given me and lived up to what is the American dream, which is a very high standard to meet for immigrant families like my own. So it feels very natural to me to see a fund that was going to be the first bet, that first check, that family and friends round into immigrant entrepreneurs and say, I want to be part of that. I want to make it easier for them and help them succeed faster.
Manan, how do you plan to do things differently than traditional venture capital firms? Like when it comes to decision time, where do you see yourself making a decision than partners at other firms might?
Yeah, one of the things Maria hinted on was we really try to be that first check. And I think what that means in true statistical relevance is that 60% of our commitments happen before the company was even incorporated, meaning they don't have a Delaware C Corp. And what that really reflects is this idea of being a friends and family type of investor. And so for us, it really comes down to challenging some of the pattern recognition behaviors of Silicon Valley VC, and specifically basing an investment decision entirely on their LinkedIn profile. Rather, we try to understand the distance they've traveled, the adversity muscle that they've built, and underwrite the people, fully recognizing that their ideas might shift, but the people who will solve a problem won't.
Maria, you mentioned you're a former refugee yourself. You also worked for Forward US, the immigration lobbying group founded by Mark Zuckerberg. And I'm curious what insight that gave you into others' experiences that might be similar but still different than your own.
Yeah, I mean, look, there's the numbers can speak for themselves, right? In the United States, the population of foreign-born folks are about 14%. But we also know that 20% of the self-employed population happen to be foreign-born. And when you look at just tech alone, about 20 to 25% on any given year are startup entrepreneurs are foreign-born. And when you look at just unicorn companies, so those that are over $1 billion, that gets closer to 50% of them being founded by these. And so when you look at our economy, whether it is the small businesses, the mom and pop shops, or the most sophisticated technology companies, I mean, we're talking Google, PayPal, Tesla, Apple, all founded or co-founded by immigrant entrepreneurs. There's clearly a journey there and this muscle to innovate. And when you think about who has a competitive advantage and a global viewpoint to build global companies with massive market caps, it's going to be immigrant entrepreneurs.
We're nearing a deadline where the green cards of 80,000 people currently working in the United States might expire. Manan, what are your thoughts on this? What do you think needs to happen here?
Well, when you think about the reason for this happening, it's fundamentally because of something that no one expected to happen globally, right? A lot of this backlog in expiration is because of the global pandemic. And so just like we've done for many other categories and other things around this country, specifically around policy, I think we need to take the same approach here and give people whose deadlines are coming up or have just passed, give them at least 6 to 12 more months to stay in status and go through the process as our Department of Homeland Security and USCIS restaff and get through that backlog. It would be an absolute travesty for this many people who are predominantly tech workers to not be able to know that they can still work here when they've already paid so much in taxes and given back to the country in such a meaningful way.
Maria, is your fund going to be helping immigrant founders secure visas? Will you help them navigate this process?
Yeah, I think a unique part of how we structured the fund from day one was we know that it takes a lot of time, and time is something that entrepreneurs do not have in the early days of company building with so many things and involves that they're juggling in there. And so we have an in-house immigration council that helps each of our founders figure out what is the best pathway forward, right? A couple of answers, right? How do we get you working on your company full time as soon as possible? And how do we make sure that when this company is successful 5 to 10 years from now, you have figured out a way for you to stay in this country and work and make new American jobs? And so we are one of the few, if not the only fund out there that has immigration team focused solely on providing this support to immigrant founders day one.
Milken, you backed a startup called Hire Club, which just filed for bankruptcy last week. I know not everyone is going to be a winner, but what's your take on that and anything that maybe the company could have done differently?
It's a great question. And look, I think this was one of those situations where, as California passed AB 5, some of the contract worker statuses also affected that company. And while certainly the company intends to continue to stay in business, the CEO just announced that he helped somebody negotiate a record improvement in salary of $200,000. Think about that, $200,000 higher salary by getting some help from Hire Club. We think this business should be around. The CEO is fantastic. And I think his story is not done. And so this is part of the bigger narrative that we really believe in is foreign-born entrepreneurs really will continue to go big so they don't have to go home. And I think that's what kind of embodies that American dream in that story so well.
Go big so you don't have to go home. That's something that I can get behind. Manan Mehta and Maria Salamanca from Unshackled Ventures, thank you both. We'll keep following your story. All right, coming up, we're going to bring you live to the Milken Institute Global Conference in LA. Bloomberg's Carol Massar will be sitting down with Cathie Wood of Ark Invest. Always a lot to say there. You don't want to miss it. This is Bloomberg. This is Bloomberg Technology. I'm Emily Chang in San Francisco. Let's take you now to the Milken Institute Global Conference in Los Angeles, where my colleague Carol Massar is speaking with Ark Invest's Cathie Wood.
Let's go back, because how did you get here? I mean, my gut from just talking to you is that there was no plan to be a celebrity fund manager and someone that we print out a story every day about your comings and goings. So what was your plan?
Well, my plan was...
Because you've been in the financial industry
Yes,
for a long
I've been
time.
in the financial industry, and after the tech and telecom bust, and then even more so after 08, 09, I began to see just incredible risk aversion, career risk, business risk, and everybody was worshiping the almighty index benchmarks. And that was not consistent with what we were doing at all. So we were becoming, I describe it as an otter duck, you know? And I also felt this was very bad behavior. I feel like maybe investing in tried and true is not wrong, but investing only in the past, I do believe is wrong, you know, because there are so many, there is so much in the way of innovation evolving, and I did not feel like it could be funded appropriately in the public markets. The private markets were screaming, so valuations were crazy there. The same kind of stock was selling for a fraction of the valuation in the public markets.
Right.
And so I felt there was an arbitrage opportunity. Many people in the public world said, oh, those private valuations, those are going to crash. We didn't think that was true. We thought the public market valuations were going to move up. So I felt that this focus on innovation had been lost, research lost, investing lost in the public markets. And I said, we could fulfill a huge unmet need and change this misallocation of capital, which is all about the past, especially because of the explosive growth opportunities there are in the future.
How hard was it in the early days? And you essentially bootstrapped it, what, for 3 years?
Yes.
And you had people working at home, right?
No, we all worked in an office.
Oh, you all worked in an office,
We worked in an office, yes.
But how hard was it?
That was that was a very important part of coming together. The bonds that we created during that time will never leave us. So how was it in the early days? We were on a mission. And I never thought we were going to fail. Many other people thought we were going to fail.
Right.
I remember Eric Balchunas is very kind in the beginning. He's very kind and says
Bloomberg follows
at
ETFs.
Bloomberg he's I think your top ETF journalist, and he really thought we were destined for failure, and basically told me so in a very nice way, but I just didn't believe that. And one of the reasons people thought we were going to fail is here we chose a wrapper that was dominated by passive portfolios and put an active strategy in there, and people thought that was crazy. Now, after 2.5 years of no traction, effectively, I began to say, "Wow, was that a bad move?" And so we started doing separately managed accounts and so forth. But it turns out that that was a great decision because so many people thought it was such an awful decision.
Right.
We had so much visibility that when we started to gain traction, when the inflows started, it was like a head fake, and it got us so much more attention than we would have gotten otherwise.
Welcome back to Bloomberg Technology. Let's get back to the Milken Institute Global Conference in LA, where Bloomberg's Carol Massar is speaking with Cathie Wood of ARK Invest.
I mean, what were institutional investors saying to you in the early days when you made your pitch?
Too volatile. That was the pitch. I mean, that was the response. Too volatile. We couldn't possibly do that. And here we are. We are a volatile strategy.
Right.
And our response was, well, volatility on the upside is not a bad thing.
Right.
And last year was a good example of that. But the other thing we said at the time, and we actually took our cues from a value investor who said to us, I would never buy one stock in your portfolio, but I like your research and you might be right, so I'm going to just put 5%. This is a value investor, 5% as a hedge. And as did our first institutional investor, which is value-oriented,
right.
And kind of thought we were behaving like a value manager, long-term time horizon, and looking for extreme values. Well, value investors are using price to book and dividend yield and that sort of thing. We're using growth. We're using spectacular growth rates that no one is expecting. And Tesla was our first proof of concept, I would say, a very visible one, where people were saying, what are they talking about? And all we had done was used Wright's Law, which is the centerpiece of our research, to try and figure out how quickly costs would decline in battery pack systems, and therefore how much prices would fall for electric vehicles and how quickly the uptake would be. And we saw Elon Musk, magnificent things happening in terms of
But it wasn't
cost.
so easy to be invested in Tesla early on.
For us, it was easy.
Because you just believed the story, or?
The most important call that we made initially with Tesla was All right, Tesla's battery technology is unlike any other auto manufacturer's battery technology. Tesla was riding down the cost curve of the consumer electronics industry. So laptops, cell phones, huge volumes, right? And when you get a scaling like that, costs come down. It's called a learning curve in the tech industry. So Elon, you had auto manufacturers and auto analysts laughing at him. Elon is building his car on top of cell phone batteries. Isn't that funny? And what they didn't believe was that the engineering was possible.
Right.
So there was they just didn't think it was possible. And he did. And so even today, these cylindrical batteries that he's been using relative to lithium-ion pouch, lower cost and will remain lower cost for at least 3 years, we think, which means that any other auto manufacturer who wants the same performance and the same range at the same price will have to lose money on every car sold.
So it keeps him in a really great position.
And that's only one of 4 barriers to entry.
Well,
but that was the first call we had to make.
So Elon Musk and Tesla. So there is a point that you would get out. I know there's a story you've talked about. You put a mark on the stock price. I think it was 3,000?
Yeah, 3,000 is our base case, not our bull case, but our base case.
Okay, so there is a point where you could say, okay, I'm moving on. You've gotten out of Apple. I mean, these are backward-looking companies or technologies that you don't think are, or not necessarily?
Not necessarily. They are very well understood. Their dynamics are well understood. They are the FANGs. Right. They're well owned. And we just want our clients to be exposed to the next FANGs, which are not going to be in the FANG category, but the next FANGs. And Tesla's becoming a FANG. You know, I think it'll end up in that grouping at some point. Yeah, we would sell. So our minimum hurdle rate of return expectation for a stock is 15% at an annualized rate over 5 years. So a doubling over 5 years. Tesla is about nearly a quadrupling over 5 years, so well within our range. So, you know, we have been taking profits, and that's because Tesla in here, I think it's becoming very obvious now that electric vehicles are taking massive share from traditional gas-powered vehicles. And so the stock finally is responding to that reality, because that has been true.
Bounce back.
Yes, it has. Whereas much of our portfolio has still been in a bit of a weak spot. So this is called portfolio management. That's all this is.
Well, let's talk performance, because it's been off the charts, and it was certainly last year. This year, it's been a little bit tougher. If I go last year, 5 of ARC's 7 ETFs returned an average of 141%. 3 were the top performers among all U.S. funds. We wrote the story. You were the top stock picker in 2020. This year, if we look at ARC Innovation, down around 25% from its peak in February of this year. Yeah. It's up 7% for the year. What's tougher about this year for you guys?
Well, it's not tougher. We expected it and wanted it, actually. Not that we want our stocks to go down, but what we didn't want was another bubble, which was when the market became more and more narrowly focused on just one group.
Right.
Instead, what happened, energy's up 50% this year, financials are up 30%, and oh, by the way, we think those 2 sectors are going to be the most disrupted of any. But what's happened is there has been a rotation into value as a style, as fears of inflation and interest rates increasing picked up, and therefore there's been a broadening out of this bull market. I think we are in a very strong bull market, very strong bull market. It has overcome a doubling of interest rates, long-term interest rates in the first quarter, all of this tax talk, all of this strife.
No worry that there's so much money chasing too many options? I mean,
am I worried about inflation? Is that the question? Yes.
Well, and bubbles within the market.
Not bubbles. I can tell you, the way I know that is from the nature of the questioning that we get when we go into any meeting, retail or institutional.
Right.
It's much more about risks, very little about opportunity. That's not what happens during a bubble. But inflation, now we do have a differentiated point of view there. Art Laffer is my mentor. We did an interview with you.
We talked about it.
Yes. And so I've always had to, as part of my portfolio management perspective, I've always had to have an understanding of the economic backdrop.
You actually debated Henry Kaufman way back when.
Oh, yes.
From what I understand, when you were
I was at Jennison. Jennison, Henry Kaufman, Al Wojtlauer, Gary Winkowski.
The original Dr. Doom.
Yeah, Doctors Doom and Gloom. No, Doctors Doom and Death. Right. Yeah.
Yeah.
Yes. And so, and that's where I learned about, wow, if everyone is going in that direction, and back then it was inflation and interest rates are embedded in the system at a double-digit rate. This is the early 80s.
Right.
And someone dares to go the opposite way after those who had gone the opposite way had been bludgeoned with higher interest rates and higher inflation. So this was timing. There's a lot of money to be made. And that's how I felt about innovation. And that's how I still feel about it. So inflation. We expected inflation. I do these YouTube videos, and we started talking about the base effect and supply chain issues last year. I didn't expect a second round of supply chain issues where now we have people hoarding because of Christmas. That I didn't expect.
Right.
And so we're getting another round of inventory building, but not in businesses, in homes. Mm-hmm. That car they bought last year is in their driveway or their garage. Auto sales, many people don't realize this, in the US peaked in April at 18.5 million units and are now at 12. Now, that is not just chip shortages.
Yeah.
That is, I bought my car last year, I'm probably never buying another gas car again, I'm gonna wait for an electric vehicle. That's what I think is going on, or some of what's going on.
Right.
So if we're right on that, then I think there's a lot of double and triple ordering in the system right now. This happens at the end of every cycle, and certainly when there is talk of shortages.
Building up your inventories, whatever they may be.
Toilet paper,
right.
Tissues and all of that, Clorox. And so I do believe that after Christmas, we will see the other side of this.
Welcome back to Bloomberg Technology. More of our conversation now with ARK Invest CEO and CIO Cathie Wood. Here's my colleague Carol Masser at the Milken Institute Global Conference in LA.
Tell me a little bit more about Bitcoin and where you see, I've never seen anything so debated. Obviously, we're seeing more legitimization as we see regulators, certainly in the US and around the world, moving forward. Today was a big day. What is the long-term play when it comes to something like cryptocurrencies and Bitcoin?
So Bitcoin specifically, we got involved when it was a $6 billion market cap, and here's Art Laffer again in my life and in ARK's life. It was a $6 billion cap then, now it's over $1 trillion, which is, but we were asking the question, this was 2015, could Bitcoin serve the three roles of money? And we came to the conclusion that it was possible. Art Laffer collaborated, he tore our original paper up, and as we were going through it, he said, this is the rules-based monetary system I've been waiting for since we left the gold exchange standard, 1971.
Right.
And I said to him, oh, how big could this be? And he said, well, how big is the US monetary base? And back then, remember, this is a $6 billion cap. Back then, it was a $4.5 trillion monetary base. Today, we're at $8.5 trillion. And Bitcoin's at $1 trillion. And that's just one of its roles, I think the most fascinating thing that's happening is in El Salvador. Have you heard? They deemed Bitcoin, the president, who tweets every day, deemed Bitcoin legal tender. And
it was a Bloomberg quiz question.
Okay.
We do it every week. Anyway.
Okay. And sent a Chivo wallet to everyone in the population eligible, so 4 million. 3 million, it had $30 worth of Bitcoin in it. 3 million have downloaded it. Only 1.2 million in that country have a banking relationship. So this is the new bank, digital wallets, and it's going to be true in this country, it's going to be true around the world.
So all in.
All in.
China,
yes.
You've been in, you've been out. And sometimes we're trying to understand.
Yes,
So how are we supposed to look at China right now and the clampdowns that we've seen in the government, certainly on different sectors that have just decimated those sectors in terms of the value of them?
Yes.
So what do you expect kind of to be your involvement?
Yes,
an investment play.
Our first move away from China was when China was had a very strong move, and the innovation there was being deeply appreciated while ours was not. So that was that kind of move. The second time we moved in, or then we moved in, why? We saw the reaction to COVID, and we got more interested because it was the most disciplined country in terms of both monetary and fiscal policy during the crisis. And I thought that China had the possibility of becoming the Germany and Switzerland of the world, in terms of discipline, monetary and fiscal. As soon as Jack Ma was banished, effectively, last November, we started pulling back. Because what we're doing, and especially during February through May, where our strategy, just to give you a sense how volatile that is, our strategy from mid-February through mid-May, most people wouldn't admit this maybe, but this is how volatile we are. Transparency was down 37%, peak to trough. So we have come back, but during that period, what we do, as we always do, we concentrated our portfolio towards our highest conviction names. China was moving away because almost every week and month there was a new regulatory move or crackdown. And so it was easy to do that. It was great because I'm always scrambling, looking for cash during a correction. Okay, where's the confidence lower? Where let's buy into some of these, our favorites here. Now, common prosperity. So what have we done? No China in our flagship. We do own some China in a few of our portfolios, the ones focused on autonomous technology and robotics. But we're very particular. Very low margin companies, because margin is clearly not appreciated by the government anymore. Common prosperity. And very beneficial to tier 3, tier 4 cities, common prosperity. So JD Logistics, JD.com, Pinduoduo.
Does it stay this way, do you think, in China for a while?
Well,
I mean, it's hard to say, but China is certainly a country when they make a decision, it's longer term. It's longer term planning.
Right.
And President Xi certainly seems to be on this mission.
And I think he is very unsettled that the 3-child policy is not working.
Yeah.
And so there's a big social engineering. And by the way, this was all very forecastable, right? I mean, demographics, they knew 50 years ago what was going to happen.
Right.
So I think that's part of it. And, there are the haves and the have-nots in China like there is around the world. I think China's taking it more seriously because there's probably more social unrest than we now appreciate. What I don't understand is they're going after real estate, which is 75% of the consumer savings in China.
Individuals in China.
And if individual saving. If the prices are going down, which they have been, I think that could really hurt consumer confidence. I think it already is. And then last weekend, or the weekend before, the national government went after the regulators who had focused on the financial industry, as well as the financial institutions. And I'm just saying, wow, they're playing with fire.
It's a moving, yeah.
And talk about a cyclical risk out there. Think about that if we lose China. At the margin, China has been responsible for a tremendous amount of cyclical growth.
Right.
And commodity price inflation.
Did an M&A panel here, and one of the risks that one of the bankers brought up is that China specifically, geopolitical even though, in terms of military tension. So everybody's watching. So the future.
Yeah.
It's in Florida.
Oh, yes.
How come?
Most people would tell you there are tax considerations and so forth.
Is that
of course, that's part of it, of course. However, We were looking for a city that might be able to evolve into something like Austin has. And
Do you think it can
yes,
be Austin?
I absolutely
Why?
do. If you have not been to St. Pete, you must go. I've now become St. Pete's official ambassador. So
Who's been to St. Pete?
St. Pete?
All right, fair amount of people.
It is, I mean, all my life I've said, I will never live in Florida. And here I am. I went to St. Pete. It is a young, vibrant town focused on culture, arts, music, a lot of tourism, very clean, very lovely, very friendly people from all over the place. And I do think we could have something like a South by Southwest in the St. Pete, Tampa region. I think Tampa is very exciting as well.
That was ARK Invest Cathie Wood speaking with Carol Masser, my colleague. And that does it for this edition of Bloomberg Technology. Make sure you tune in tomorrow. We're going to be digging in to earnings from Tesla and IBM. I'm Emily Chang in San Francisco. This is Bloomberg.